Okay.
Can you explain what credit is and why is it important?
Yeah, simply credit is just trust. The technical definition is I can buy some goods or I can buy a service and I don't have to make a payment.
Okay.
So whoever is lending me the money, because I'm a borrower, if they extend me credit, I can get something first without paying for it because they trust me to pay them back.
Okay.
And so what they'll do, for example, here in our business, we can order like these books. So I have all of my books printed, and they will print them before I pay for them. So that's credit. And I'll have what is called a net 30. So I have 30 days to pay back what I borrow in terms of the cost to print the book. And if I do not pay it back in 30 days, then they will add interest. So if it may cost me $300 to have 100 books printed, so if I pay the $300 before the 30 days, it's like same as cash. If I do not pay it back in 30 days, that $300 could increase to $325, $310. So credit is when you get something in advance and pay for it later. You can also do what is called have a credit card. And so what a credit card will do is like cash. You can take the credit card, purchase something, buy some services from someone, and then they'll give you 30 days to pay that money back. And again, if you do not pay it back within the 30 days, you'll have to owe what you borrowed and interest on top of that. And so if you want to have good credit, you have to learn to be someone who's trustworthy, and then also show that you've got a history of managing money well. And as you continue to do that, you'll get more and more credit.
So you said if you don't pay it back in time, you pay interest. On the news now we see interest rates are rising. Is that the interest, that number?
So that's a good question. So whenever we hear the Federal Reserve has raised interest rates, what they're talking about is the federal funds rate. So the federal funds rate is, so the federal being the Federal Reserve, funds rate is actually what they charge banks when they borrow money from the U.S. Treasury. And so whenever the Fed raises the Fed funds rate, that means banks have to pay back interest on the money they borrow from the government at a higher rate. So this is how business works. If the bank who's loaning us money are being charged more by the people they're getting their money from, in turn, they're going to charge us more. So it has a connection or a correlation, but it's not the exact same thing. So it's a very good question, because what we want to make sure people who are listening to us is they're knowledgeable that when they hear the Federal Reserve is raising interest rates, that doesn't automatically mean your credit card interest rates going up, your mortgage interest rates are going up. It just means the banks who we get our money from, they're having to pay more back to the Federal Reserve or the U.S. Treasury, so in turn, they're going to charge us more.
So it's like a little supply chain. So it's like Federal Reserve up here, if it costs more for them, they're going to come down to the banks. And then if it costs more for the banks, it comes down to us. So it's
not going to cost the Federal Reserve, because Federal Reserve actually is the one that regulates all of this. So it's not costing them anything, but it's their responsibility to keep the economies of scale in order.
Okay.
So to make sure that, why did they raise interest rates? Because inflation was getting too high. So one of the powers that the Federal Reserve has is they can raise interest rates that will have an alternate impact, where if they raise interest rates, what they're trying to do is cool things off.
Okay.
They're trying to slow people down, because if I have to pay back more, I may not borrow as much. Because unfortunately what we've had since the 80s, 90s, early 2000s is interest rates have been so low, people have been borrowing so much. Now the Federal Reserve is saying, hold on, things have gotten out of hand, let's kind of bring some things back. So yes, it's a supply chain, but also I want to make sure people understand it's how business works. Because remember what I said, the banks are having to pay back more.
Okay.
So in turn, they want to keep their profit the same. So they then charge us, the customers, more. So now when we go get a car loan, instead of it being at 4% last year, now it's 6%. So it hasn't cost the bank anymore. It's just to help them keep their profit margins the same. And so it's going to be interesting when inflation comes down, will banks lower those rates?
Well, they would have to, right?
Well, they don't technically have to, because they may feel you've been comfortable paying it at 6, let's keep it at 6, even though we could bring it down to 4.
And then they just make more money.
Because we want to have our profits even higher. So that's going to be something to watch. I'm not saying they're going to do that, but something to consider.
Okay, so the next